Hello friends, this is Hatim Rampurawala, and in this video we will revise chapter number 6, decision making, illustrations as well as question knowledge. Okay, so let's proceed. First illustration: Catalyst Limited make a single product with the following detail: selling price, direct cost they were given, then number of the setup they were given 42. There is a current situation as well as proposed situation in the question. Setup cost per setup cost they have given, then production run 960, production unit per run, then engineering hours and the cost per hour they have given. Okay, there is a proposed changes which they have made. That is, setup cost has reduced by 90, so it will be 360. Production units per run has been increased, so okay, and engineering hours has been reduced. Now what they have given further is, the company has begun the activity based costing of the fixed cost and presently identified two cost driver: production run and engineering hours of the total fixed cost presently at 96,000. Above after the above 72,100 remained to be analyzed. Okay, this are still being remained to be analyzed. There are changes as proposed above for the next generation period for the same volume of the output. So there are changes for the next production for the same volume of output. So we have to keep the volume of output as same. So how much is the volume? That is 42 in the current situation. 42 into 960 will amount to 40,320 approx. That will be the quantity of the input. That output, the quantity that will remain the same for the proposed as well. That we will divide by 1008. So we'll get the number of the setup, proposed number of the setup run, that is 40, and by that we will calculate. See what they were given is first required part: compute the unit and the production run of the catalyst. So we have to calculate unit also, and the how much units and how much production run catalyst should produced in the changed scenario for the break even. So for break even, how much is the unit, how much is the production run, and advised whether the catalyst should continue to break up at the remaining fixed. So it should break up with the remaining fixed, or should into the activity based costing or not, that we have to advise. So what is this solution? First they have given the current and the proposed situation, the same thing which we discussed, how that figure will be arrived. So in current it is 42 number of the runs or the setups, in proposed it is 40. How this 40 came is 960 multiplied by 42 divided by 1008, and setup cost is 450, 360. Then production unit run is 960, 1008. This has been given in the question. Production run is will be the same as they have given, that production unit will remain the same in the proposed situation also. Engineering hours 500, 422, and engineering cost is 10 and 10. Okay, now how to calculate the break even is, first we'll take fixed cost, then setup cost into number of the setup, then engineering cost into number of engineering hours divided by variable contribution basically. So what is the formula basically is fixed cost divided by contribution per unit. We will get 18144, that is by calculating the above numerics, we will get 18,144. And for the break even runs, what we will do is divided by production per run, that is divided by 1008. We will get 18 runs in all. That will be the break even units and break even run. Now the second thing they had asked is to whether to, what we can say, what it was, that advise the catalyst should continue to break up the remaining fixed cost, so that currently it is 70 to 100. So whether they need to further break down the fixed into the activity based cost. So what is the solution? The company should adopt the activity based costing system for the accurate product pricing. So why the company adopt is activity based costing? For the accurate product pricing, as a traditional volume based cost system does not take into account the non unit level overhead cost such as setup, inspection, material cost. So this all is not been taken into consideration into the traditional costing, which ABC takes into consideration. Now analyze the ABC system shows that analysis of the ABC system, if we do by the ABC system, shows that while these costs are larger fixed with respect to the sales volume, but they are not fixed with appropriate cost driver. Even though this cost, all costs are fixed with the sales volume, but they are not cost fixed, they are not fixed to the appropriate cost driver. If the breakup of the remaining 70 to 100 consists of only the small portion, then ABC need not be applied. So if this 70 to 100 consists the breakup of only the what we can say, this small portion of the total cost, so ABC need not be applied. So ABC will not be applied basically. Then, however, if the company wants to note that the primary study has resulted in the cost saving, that is, if the saving in cost are expected to exceed the cost of the study and implementing, so what they were given is, however, it would also be noted that the primary study has resulted into cost saving if the saving of the cost are expected to exceed the cost of the study of the implementing ABC. It may be justified. So implementing ABC will be justified when the cost of implementing it is less than the cost, less than the saving which we have generated. Okay. Further, it is pertinent to mention that the ABC offers no increase in the product costing accuracy for single product setting. So for single product price setting, setting, ABC do not increase in the product accuracy, product costing accuracy for the single product costing. Okay. Let's move on to illustration 2. Okay, this is also beautiful question. So actually what we will do in this chapter, basically in 6th chapter, is we will make one video. We will do all illustration in one video and all the test your knowledge in the another video. So it will be in 2 parts, part 1 and part 2. So this is the part 1 basically. So let's continue with this illustration number 2. Second illustration. Expert Roadway Services Private Limited is planning to run a fleet of 15 buses in Jaipur on a fixed route. The company has estimated a total cost of 2 crore 51 lakh 85,000 passenger kilometer per annum. It is estimated that the bus to have 100 load factor. The bus are purchased at a price 44,000 per unit, whose scrap value at the end of the 5th year is so they are purchased at 44 lakh. The scrap value is 5 lakh 50,000. So we'll deduct from that for calculation of the depreciation. Sitting capacity of the bus excluding a driver seat is 42. Each bus can run a mileage of 5 km per liter. Average cost of a fuel is 66. Cost of the lubricant and the sundries per 1000 km would be 3,300. So cost of the sundry is, for every 1000 it is 3,300. The company would pay 27,500 per month to the driver and the 2 attendants. So to all, so this 27,500 includes for what we can say, for the driver as well and as well as for the 2 attendant. The other annual charges per bus: insurance, it is insurance 55, garage 33, repair maintenance 55,000, route permit is 20,000 km for every 5,000 and 2,200 rupees for every additional 5,000 or part thereof. Required part: calculate a suggested fare price per passenger kilometer. So we have to calculate per passenger kilometer, and also for one bus. Actually it there, even though it is 15 bus, so we'll calculate for one bus, taking into account the taking into account the markup. I don't know how the word breakup came, but you can relate with yourself. Sorry, I was just cracking joke. Taking into account the markup on cost at the rate of 20% to cover the general overheads and the sufficient profit. Okay, so they have not said anything, they have just said suggest the fare price. So we need to calculate the fare price per kilometer per passenger, taking into account the cost, and what will be the profit is cost plus cost at the rate of 20% to cover the general overheads and sufficient profit. Okay, now let me, actually I should ask whether, I don't know, I had gone a little fast in first illustration because I thought it was much simpler, and the same speed I am thinking of keeping in the further illustration as well, because since it is a revision and since there are many illustration, so unnecessarily. It is not that we cannot discuss in detail, but while discussing in detail, it will defeat actually the purpose of the revision in quick short time span. So that for that purpose, I would be assuming that at least you would have done this at once, so if so that this video could be helpful for your revision purpose. Okay, now but we will do entire sum in logically, that is how that figure arrived, that I will properly show you. Okay, so in first they have asked the fare price, so we'll prepare a statement suggesting the fare price kilometer each bus. So we will write each and every cost. Insurance cost they have given 51,000, garage they have given 33,000, depreciation they have calculated 7,70,000. How the 7,70,000 came is 44 lakh minus 5,500 divided by 5 years. Yeah, buses price was this much, and scrap buses were purchased at 44 lakh, whose scrap value at the end of which is 5,000. So 44 lakh minus 5,50,000 divided by 5 years. We'll continue. Then what the next cost they have took is running expenses, repair and maintenance 55,000 as they have given in the question as well, question directly. Then cost of lubricant and sundries is 138,517.5. So now how this cost came is just simply first we have to calculate the kilometers. So how much kilometers there will be in all. So first what you do is take 2 crore 51,000 51 lakh 85,000 on your calci, then divide it with, so this is the passenger kilometer, total passenger kilometer of 15 bus, so divide by 15, so this will be for one bus, and divide by 40 passenger, because even though there were 42 seats, but 2 seats were for the 2 attendant, so in all passenger will be 40, so divide by 40 will get the kilometers as 41,975 kilometer, and for every 1,000 kilometers, so we'll divide by 1,000, that 41,000 will divide by 1,000 will get 41.975, that will multiply by 3,300, so we'll get 138,517.5. Then fuel cost is 55,4,070, that can also derived as how much kilometer we have got is 41,975, correct na? 41,975. Then that multiplied by 65, how much cost they have said is 66 per liter into 66, wait a second, 66 into 41,975. No, I am going somewhere wrong. Okay, and each bus can give a mileage of 5 kilometers, so we'll divide by 5 as well. Okay, sorry, so what we have to do is 41,975 divided by 5 and thus multiply by 66, so we'll get 54,4,070 as our fuel cost. Then salary will be as they had said, salary and to driver and 2 attendant is 27,500 per month. We'll simply multiply it by 12, we'll get 3,30,000. Route permit charges they have given as 16,500 in question itself, so the total cost is 19,52,087. We will add 20% markup on the cost, so if the cost is 100, so 20% will amount to 52,087. Take the cost figure on the calci, multiplied by 20%, so that will be the markup, and then add that both, so we'll get the total revenue. So rate per customer will be, this is for 23 42 505, this we will divide by passenger per kilometer. See in the working note below they have given as passenger per kilometer is 16,79,000, 16,79,000, so we'll get 1.395. So it is like this is the rate per passenger per kilometer. Now what they had asked in the second part of the question, sorry,
Okay, we'll continue. So the first part is done. In the next part, they have asked is the transport sector of the Birpur is highly regulated. The government has fixed the fare price at 1.35. So it is regulated by the government. Government has fixed the selling price as well for the next 2 years. Comment on the 2 years profitability taking into consideration an inflation rate of 8%. So 2 years we have to take into consideration, and into consideration the inflation rate of 8%. Note, the route permit charges is not subjected to the inflation. So, they have given route permit is not subjected to inflation. You have to also note that depreciation will also be not subjected to inflation, and apart from the depreciation and route permit, all will be subjected to the inflation. We will calculate, we will prepare the same column, but in this we have just prepared one column. In the next we will prepare year 1 and year 2. Write the same, prepare it in the same manner. We will just add up 8% in year 1 also, and we will add up 8% in year 2. And except for the depreciation and route permit charges, we will arrive at the cost and the total revenue which is regulated by the government. So government regulated is 1.35 into 16,49,000, and we had as 16,79,000 multiplied by 1.35, we will get 22,66,650 as the revenue, and our profit will be 2,21,000 for the first year, and 1,20,000 for the second year, and the profit to the revenue ratio will be 9.76% and 5.32%. So we can see that it is reducing. So in the first part, what was the profit, the percentage of the profit on sales? It was 16.6% on the total revenue. It got reduced after inflation in year 1 as 9.76, and in year 2 it got reduced. So due to the increase in the cost, but since the selling price is fixed, so we are incurring high cost, and the selling price is fixed. Since it is fixed, so our profit margin will gradually decrease only. So the conclusion is over here. The gross margin is showing a downward trend because the cost component have taken into the effect the inflation rate, hence the increasing year by year, but the total revenue had remained stagnant due to the government regulation, which has resulted in the reduction in the gross profit margin per bus. The company gross margin to the total revenue ratio has came down to be 9.76 and 5.32 in the first and the second year respectively. So it has reduced from 16% respectively, but the initial company desired margin to the total revenue was 16.67, as we had seen in the earlier first calculation, to cover the general overheads and sufficient profit. Though the amount of the general overhead is not given, but we can safely assume that they may also be subjected to inflation. Even though general overhead is not given, but they may subjected to inflation, that is the increase in the year by year. Then in such a cases, the company needs to maintain or increase its gross margin per bus to maintain the net profit. So what the company also needs to do is increase the margin as well to maintain its profit after the general overheads, which is not possible in the regulated environment. We can't increase the margin. So gradually what will be happening is there will be always there will be year by year increasing in the cost, but due to the same profit, that is due to the stagnant price of the stated by the government, we will reach a point when there can be a higher cost and low revenue, or negative revenue we will reach. So what they have given is means generally we can suffer loss also in coming years. So the information about the regulated fare in the given case, in the first year and the second year only is given for the first year and the second year, but if it is regulated fare scenario persists for the further years also, then the project may not be viable for the company. So this project may not be viable because it will result into the loss after a certain point of time. Total cost, we can see this formula: total cost is equal to fixed cost plus variable cost into number of unit and engineering cost into number of unit. This formula we had used in the earlier first the first illustration which we did. Okay, that is, I just referred that, else there isn't it. Okay, now this illustration, this is also a nice sum. See, recently the Recently, the Ministry of the Health and the Family Welfare, along with the Drug Control Department, have came hard on the healthcare center for charging the exorbitant fees from their patient. Human Healthcare Limited, a leading integrated healthcare delivery provider company, is feeling pinch of measures taken by the authorities and facing margin pressures. Due to this, the HHCL is operating in the competitive environment, so it is difficult to increase the patient numbers. Also, the management consultant of the company has came out with the plan of the cost control and the cost reduction. So earlier first paragraph was just an introductory paragraph, nothing much relevant information relating to the sum has been given. Then HHCL provides the treatment under the package system, where the fees is charged irrespective of the number of the days in the hospital. Has estimated consultant has estimated 2.5 patient per day. He wants to reduce it to 2 days. So patient are generally taking is 2.5 days to recover, 2.5 per patient per days. He want to reduce it to 2. So we will read the second para again. HHCL provide the treatment under the package system, where the fees is charged irrespective of the days patient stays in the hospital. Consultant has estimated 2.5 patient day per 2.5 patient days per patient. He wanted to reduce it to 2 days. By doing this, the consultant has targeted the general variable cost of 500 per patient day, annual 1005 and annually 15,000 patient visits to the hospital. So simply what calculation we have to do is 15,000 visits are there, and they are reducing this cost to reducing the patient day to from 2.5 to 2. So what we'll do is 2500 sorry 2.5 minus 2, it is 0.5 into 500 multiply by 15,000. Okay, so what it will come is 0.5 into 15,000 into 500, which amounts to 37,50,000. Okay, that will be the saving actually, because they are saying saving in the cost by reducing it from 2.5 to 2 patient days. Then medical superintendent has some concern with that of the consultant plan. According to him, reducing the patient day would be detrimental to the full recovery. Reducing the day would be detrimental to the full recovery of the patient. That would come again for the admission, thereby increasing the current admission rate from 3 to 5%. So the patient admission rate will increases. So from 3 to 5%, it means that admitting 300 additional patient, the company spends 15 lakh 25 lakh. So this is the cost, basically 25 lakh is the cost, and the revenue is 300 additional patient, which in the last para they have said which contributes to 4,500 per patient in the form of an admission fee. So multiply by 4,500, it amounts to 13,50,000. So the total gain is saving is 13,50,000 plus 37,50,000 earlier, which we calculated, minus 25 lakh is the cost. So the net benefit is 26 lakh. Calculate the impact of the management consultant plan on the profit of the company. Management consultant plan on the profit, so it will increase the profit basically, because there is a saving of 26 lakh. Also comment on result and other factors that should be kept in mind before taking any decision. That is we are asked to comment based on the financial and non-financial factor. Okay, so first we'll calculate basically incremental cost due to increased readmission, that is 25 lakh they have given in the question, and this saving of 37 and 13,50,000 resulting in an incremental benefit of 26 lakh rupees, as I discussed. Now second part, comment the primary goal of the investor owned firm, investor owned firm, if it is an investor, so their motive is to wealth maximization, investor firm is shareholder wealth maximization, which translate to the stock price maximization. The management consultant plan is looking good for HCL, as there is a positive impact on the profitability, as there is a positive impact on the profitability of the company. Since it is positive impact, there is incremental 26,000 26 like there is a benefit. So what the company will prefer, that management consultant plan, so this plan is looking good for the HCL, as there is a positive impact on the profitability of the company. Also, HCL may operate in a competitive environment, so for survival it has to work on the plans like above. Since it is competing, since it is working in a competing market, competing industry, competing environment, so it has to work on the plans like above. But there is also a second side of the coin that cannot be ignored, that is humanity, value, and the business ethics. Discharging the patient before their full recovery will add discomfort and disruption to their lives, which cannot be quantified into money. There could be other severe consequences as well because of this practice. For the gaining the extra benefit, HCL cannot play with the life of the patient. So for just gaining this 26 lakh benefit, it cannot play with the life of the patient. It would put a question mark on the business ethics of the HCL. Maybe HCL may able to earn incremental profit due to this practice in the short run, but it will tarnish its image of the HCL, which would hurt the profitability in the long run. So for short term, even though the HCL may earn the profit, incremental profit, but in the long run it will tarnish the image or distort the image of the HCL, that it will affect the hurt the profitability of the in the long term. So before taking any decision into consideration or decision on this plan, HCL should analyze both quantitative as well as qualitative factors. Okay, we'll move on to next question. Okay, this illustration, this is also a much simple illustration as such. DBA manufactures and sell 25,000 table fans. One of the component required for the fan is purchased from the outside supplier at a price of 190. So it manufactures and sell 25,000. It purchases from the outside supplier at 190. One of the component. Annually it's purchasing its 25,000 component for its usage, so it is purchasing 25,000. The production manager is of the opinion that if all the components are produced at its own, it is possible to maintain the better quality of the finished product. So if we so what production manager is contending is, if we produce the product that the one which we buy from outside, if we produce on our own, so it will be of the better quality. To maintain the better quality of the finished goods, it is possible to maintain the better quality. Further, the proposed that the in-house production component with other items will be provide more flexibility to the increase in the annual production by another 5,000. So if we there is an in-house production, the quantity production will increase, so that we can produce 30,000 and we can sell 30,000. So there will be in a unit increase in the production by another 5,000. That estimate, he estimate that the cost of making the component is 80, direct material, direct labor 75, factory overheads, of which 70% is variable, is 40. So this is total, and 70% will amount to 28, I think so. 40 into 70% is 28. Yeah, 28. So the overall cost, if we will say without fixed cost, will be 195 minus 12 is 183. I calculated in the reverse man actually, deducting the fixed cost of 12, it is coming to 183, and we are purchasing at 190, so we are incurring an additional 7 rupees on purchasing, and if we manufacture, we will incur a cost of 183. So the proposal of the production manager was referred to the marketing manager of his for his remark. He pointed out that the market that to market the additional unit, the overall unit price should be reduced by 5%. So they said, for marketing this additional unit of 5,000 which we can produce, annual production will increase by 5,000, that will reduce the selling price by 5%. And additionally 1 lakh rupees per month should be incurred for the advertising. So it will cost basically, so it will reduce the contribution selling price as well, and ultimately contribution. And additionally
it will cost 1 lakh rupees per month, and for 12 months it will be 12 lakh rupees for the advertisement. Present selling price and the contribution per fan is, so this is 2500 is the selling price, which will be reduced by 5%. So if we calculate 2500 into 5% is 125. So basically there will be a reduction of 125 from the contribution of 600, which so the contribution will fall to 670 475, and at the same time it will increase by 7 per unit also, because there was a saving. If we were purchasing from outside it was 170, and manufacturing was own manufacturing was 183, so there is a profit of 7. So what we will do is 600 minus 125 because of loss of sales, which is impacting the contribution, add 7, so the current contribution is 482, and the quantity which we are selling is 30,000. No other increase or the decrease in other expenses, and as a result of this proposal will as a result of this proposal will rise. Okay. Required, since the making cost of the component is more than the buying cost, making cost is more than the buying cost, the management asks you to analyze to make or the buy decision on the basis of the total basis, unit basis and total basis, and recommend the most profitable alternative. We had discussed the entire answer with numeric as well, so I will quickly go through the solution part. You will also understand. Okay, first solution. First what they had asked is analyze the make or buy decision. Okay, DBA purchases 25,000 unit. This all we are just analyzing what we discussed above while reading the question. DBA purchases 25,000 units of the component to manufacture 25,000 of the fan. So they purchases 25,000 to manufacture 25,000 and sell 25,000. The external purchase price per customer is external purchase price is 190. It has an option of manufacturing this component in-house. The cost structure of the manufacturing this component is as below: 80, 75, 20%, 28, that is variable, only variable part of the fixed over factory overheads. It is amounting to 183. Analysis: if the DBA decides to manufacture the component in-house, so if they are manufacturing in-house, the following would be the financial impact. The production capacity will increase from 25,000 to 30,000. Variable cost of the production would be 1710. How it will be? 25,000 2500, that is the selling price, minus 600 variable cost, minus 190, that is the purchase price from the outsider. It will be 1710. The fixed factory overheads of 12 per component would be incurred irrespective of. So this factory overheads of 12, which the factory overhead overall was 40, of that variable part is 12, so this fixed will incurred irrespective, so it becomes irrelevant irrespective of whether the component is produced or not. Therefore this cost is not considered. Increasing the advertisement expenses would be 1 lakh per month, that is, or we can say 12 lakh rupees annually. Overall the selling price would reduced from the current rate of 2,500 to 2,375, that is a reduction of 125, as they had mentioned in the question. Current contribution considering the procurement price is 90. Current contribution considering the procurement price 190, it is 600 as calculated above. If the produced is in-house, wait a second, the produce, okay, if the produce is in-house, the variable cost would be 183. So purchasing from outside it is 190, in-house manufacturing is 183. This would result in an increase in the contribution by 7 per fan. The procurement price 180, unit variable less of unit variable 183. In addition, there will be an impact of 125 on account of the reduction in the selling price. So therefore the component contribution, if the component produced in-house, would be 482, as we had calculated by while discussing the above sum basically. So how this 482 arrived as 600 plus 7 increase in, that is benefited from in-house production, and reduction of selling price minus 125. To summarize the above figures, so we have to prepare this for the procurement of if it is
procure 25,000 procurement, and if it is 30,000 procurement, so what will be the units, that is per fan, and what will be the total selling price and the contribution. So earlier it was in 25,000, it was 2,500 selling price and 600 contribution, that we multiplied by 25,000 to arrive at 6 lakh 6 crore 25 lakh and 1 crore 50 lakh rupees profit contribution. But when it is 30,000, so the unit selling price is decreased by 125, so now the selling price is 2375 multiplied by 30,000, it is 7 crore 12 lakh 50,000, and contribution is 482 as calculated above, will be multiplied by 30,000, so it is amounting to 1 crore 44 lakh 60,000. Therefore the incremental loss by switching the in-house production would be 17 lakh. How the 17 lakh came? 1 crore 50 lakh minus 1 crore 44 lakh 16,000, which is amounting to 5 lakh 40,000, plus additional advertisement cost, that is 12 lakh. On this on per unit basis, it would result into 58 rupees per fan. So how this 58 came is 78 lakh 40,000 divided by 30,000. See, calculate on your calci. 17 lakh 40,000 divided by 30,000, we get 58. Perfect. Then recommendation, they would have asked for recommendation as well. Recommend the most profitable alternative. So of course, see, what could be this, what could they would have done is, they would have manufactured in-house, but they wouldn't have increased this 5,000 quantity, means they should have produced 25,000 only, but in-house. So there would be a increase in the contribution by 7 per rupees, 7 rupees, and there wouldn't be any cost or the cost of 12 lakh rupees or increase or loss of reducing the selling price by 5% in the selling price by increasing the unit to 30,000. So the conclusion will be, to maintain the profitability, the company should maintain the quantity at 25,000, but produce in-house instead of purchase sourcing it from the outside. Okay, recommendation as explained above, if the production increases from 25,000 to 30,000 fan, it would be profitable to make this component in-house. So for 25,000 to 30,000, it would not be preferable, because overall profit has decreased by 17 lakh 40,000. However, the DBA may prefer to make the component, even though it would be financially beneficial to buy from the outside supplier. Sometimes the qualitative factors become very important and can be override some financial benefit. So in this since as per, if we look at from financial point of view, the increase from 25 to 30,000 is not viable. Basically, sometimes the qualitative factors become very important and other override some financial benefit. This can be coupled with an uncertainty about the supplier's ability or intention to maintain the price, delivery and quality of the component. Okay, alternatively, the DBA may continue to sell 25,000. As I said, it should continue to sell 25,000 units without any reduction in the price and advertisement expenses. The component would be required is 25,000 units fan to be produced internally at a cost of 183 at a cost of 183. In this situation, the contribution shall be increased by 7 into 25,000, that is 1,75,000. So there would be a profit of 1,75,000 if the company has maintained the unit at 25,000 only and had opted for in-house manufacturing. Thus the DBA may choose the alternative after due consideration of the fact and as illustrated above. So after consideration of the factors, it should carefully decide which alternative to choose. We'll move on to next sum. This is an illustration. Basically, we can skip this, it isn't important much. Now this illustration, see, this is also a very nice question and actually very simple question. Excel Polymer, located in the Shahibad industrial area, manufactures the high quality industrial product. 80 Industries has asked Excel Polymer for the special job that must be completed within a week. The raw material R1 will be needed to complete the 80 industry special job. Excel Polymer purchases the R1 2 weeks ago for 7,500 for a job. So for producing of this high quality 80 industry, we will read it again. Excel Polymer, located in Saibad, manufactures high quality industrial product. 80 manufactures asked 80 industries asked Excel Polymer for the special job that must be completed within a week. The raw material R1 will be needed to complete the 80 industry special job. Okay, Excel Polymer purchases the R1 2 weeks ago. What they are done is Excel Polymer has purchased this quantity, that is this raw material R1 raw material 2 weeks ago only for 7,500 for a special job A that recently was completed. Okay, recently got completed. R1 currently is in stock, so we still have R1 in our stock in excess from that job, and the Excel Polymer had been planning to dispose it off. So Excel was thinking of disposing it off. The Excel Polymer estimated that it would cost them 1,250 to dispose R1. Current replacement cost is 6,000. So for replacement cost is 6,000. Current their disposing cost is 1,250. Special job will be required 2,005 hours, 2,250 hours of G1 and 100 hours of G2. Excel Polymer pays G1 and G2 employees 630 and 336 respectively for 42 hours a week. 42 hours. So for each hour, what will be the cost? 630 divided by 42 and 336 divided by 42. Excel Polymer anticipates having excess capacity of 150 G1. So how much we require? G1 is 250, we have 150, so we required an additional 100 only, and G2 we require 100 and we have 200, so there isn't any requirement for G2 labor in the coming week. Excel Polymer can also hire additional G1 and G2 labor on an hourly basis, so they can hire them on the hourly basis as well. This part-time employee are paid an hourly wage rate on an wage paid to the current employee. Suppose that the material and the labor comprises of the Excel Polymer only cost, so on the material and the labor is the only cost for completion of the special job. So calculate the minimum price that Excel Limited should charge for this job. Simple. So what price they should bid for this job will be, see what price we will charge. First of all, we will see from the raw material of we will see for raw material R1. For that we had purchased that material for 2 weeks ago only, and we have in our stock, and instead of disposing it at cost, we can use in for the production for 80 industries, so that can save us 1250. So there will be a saving of 1250 in raw material. And how much will be the cost in G? There are two labors required, G1 and G2. G2 is in excess, we have G2 in excess. Excess hours were available, so there won't be any cost for that. But for G1 there will be a cost for 100 hours, that is 100 hours into 630 divided by 42. How much it is coming? 630 divided by 42, it is per hour cost 15 into 100 hours, that is 1500. So we will have to incur 1500 cost for the labor G1, and there will be a saving of 1250. So the net cost will be 250, that is 1500 minus 1250, 250. So what they had asked is what shall be the minimum price? So minimum price will be 250 we should charge. We should charge in the sense Excel should charge for 280 industries. So we'll quickly go through the solution. Opportunity cost of labor. G2 labor has zero opportunity cost, as there is no other use for the time already paid for and is available. So it is already paid for G2, and there is still the resources can still be used in another project as well. So there is no opportunity cost for G2, but however for Excel Limited needs to pay for an additional amount for G1 labor. This amount can be saved if the special job were not there. So this G1 they have to incur the cost. What they are given is Excel Polymer need to pay for an additional amount for G1 because there is a short of 100 hours of G1 labor. This amount can be saved with this special job were not there. Okay. The hours required is 250, available is 150, 100 hours, and we will multiply by 15. How this 15 came? 630 divided by 42. So per hour the cost is 15. So if you multiply that with 100, opportunity cost is 1500. Thus the opportunity cost for completing the special job is 1500. The opportunity cost of material XL polymer has no alternative use for R1. They must dispose of it at a cost of 1250. Thus Excel polymer actually saves 1250 by using the material for 80 industries. So it will save 1250 for special job. Consequently the opportunity cost of the material is minus 125. So they have just given in cost as minus 125, that is actually a saving. Then the minimum price is the price at which the Excel polymer just cover its opportunity cost. Excel polymer total opportunity cost will be 250, that is 1500 minus 1250. Accordingly the minimum price for which a special minimum price for the special job is 250. Simple. 1500 minus 1250. Then we will move on to the next illustration. This is also much simpler illustration. Basically it is on the concept of to continue or to shut down the business. So we will just have to see the cost and the gains from running or closing of the firm or the unit, and then compare whether it is beneficial to shut down or whether it is beneficial to continue with that division. Okay. Rabi Limited is considering the discontinuance of division C. Following information is given. Particulars: division A and B, division C, and total sales is their respective sales is given, less variable cost, contribution, less specific avoidable cost, and divisional income they have given. Okay. The rates of the variable cost are 90% of the normal rate due to the, okay, what they have given is the rates of the variable cost are 90% of the normal rates, that is this variable cost which is given for AB 20 lakh 70,000, it is actually 90%. So if the division C is shut down, for example, see, we will read the entire, then we will conclude. We will discuss. The rate of the variable cost are 90% of the normal rate due to the current volume of the operation. So if the current volume of the current volume of operation, that is adequate, there is adequate market demand. So for current volume of operation, it is 90%. So but if there is any change in the current volume, so it will be again 100% of the 100% variable cost will be incurred for that. For any lower volume of operation, see they are given, for any lower volume of the operation, the rates would go back to the normal rates. Facilities released by discontinuing division C cannot be used for any other purpose. Okay, the facilities which all are released by, that is the resources which are being released by discontinuance of the C will not be used at any other purpose, for any other purpose. Comment on the decision of discontinuance of the C using the cost approach. So if we discontinue C, simple, we will see what all is the benefit which we will derive. If we discontinue C, we will gain the gain on the part of the fixed cost which was incurred in division C, that is 4,14,000. so that will be the saving. Okay. And what will be the cost? That is we can say cost, or we can say opportunity cost, contribution loss. So contribution loss is 241, that we will loss, and the variable cost will increase of division A and B, that is 20 lakh. It is currently 20 lakh 70,000, which is 90%. So divided by 90 into 10, it is amounting to 2 lakh 30. So we will add the cost 2 lakh 50, 2 lakh 30 plus 2 lakh 41 500, it is amounting to 4 lakh 71 500. We will deduct 4 lakh 14,000 So we are getting 57,500 negative, that is loss. So it is not beneficial for from shutting the what we can say, discontinuing division C, else instead we should continue division C. Okay, required. So we'll quickly go through the solution as given in the problem. Given in the problem, Rabi Limited is considering to discontinuous division C, perhaps by seeing the division C income as it is a loss of 172. See, it is loss of 172 in division C. So they are thinking of discontinuance of the division C might be saving of 4,14,000 in on the specific fixed cost to the company, but due to this decision, company will be losing 2,41,500 the contribution of the division C, but will also incur an additional burden of the variable cost fixed cost of 2,30,000 of division A and B and the Rabi Limited as a whole. Okay, let's assess the decision of the Rabi Limited with the help of the relevant cost approach. So as I said, first what we have to do, write a little theory concept, then particular amount, prepare a columnar table, specific fixed cost, this is the saving 4,14,000 and the cost incurred is 2,41,000 and 2,30,000. so there is an excess of loss over the saving, that is 57,500. in nutshell, considering the above analysis, we can conclude that the decision of the discontinuance of the division C will not be beneficial for the Rabi Limited. It will not be beneficial for Rabi Limited, means they should continue but not discontinue, and it should review its decision on the basis of the relevant cost approach to reach at the right decision. So it should take into consideration the proper cost approach to reach at the right decision. So we'll continue. There are two illustrations left, this one and the another last one. So we'll this is the important one because it has came once or twice in RTP and exam question. So we will solve this question, and the last one you can do on your own. It is they have asked to prepare graph and all. So I would be discussing this as the last question of chapter 6, and then we will start directly by test your knowledge. Okay, illustration number illustration, there isn't any number. BNZ Limited is engaged in the manufacture of the plastic bottles of the standard size. So BNZ generally what its business is to manufacture the plastic bottle of the standard size and produced by the joint process of the machines. The factory has 5 machines and capable of producing 40 bottles per hour. So per hour they produce 40 bottles. The variable cost per bottle is 0.32 and the selling price is 0.8. The company has received an offer from the another department for the manufacture of 40,000 units of a plastic molded toy. The price per toy is 30 and the variable cost is 24. So the price is the company has received an offer of manufacturing of 40,000 plastic molded toy. The company is in the business of bottle. It has received an offer for the toy and it has a price of 30 and manufacturing of 24. In case the company takes up the job, it has to meet the expenses by making a special mold required for the manufacturing of the toy. The cost of the mold is 1 lakh rupees. The company time study analysis shows that the machine can produce only 16 toy. So for toy they are saying that it can produce 16 toy per hour. The company has the total capacity of 10,000 hours during the period in which the toy is required to be manufactured. Okay, so it has in all 10,000 hours of the total production capacity, total capacity hours. The fixed cost excluding the cost of construction of the molds amounted to 10 lakh rupees. This is irrelevant. The company had an order for the supply of 3 lakh bottle during the period. Okay, So it has an order of 3 lakh bottles. It has received an order for 40,000 toy as well. So what they have asked specifically in the question is, do you advise the company to take up the order for the manufacturing of any plastic mold toy during the time when it has an another order in its book for the supply of 3 lakh bottle? So what we will do is first check the whether this production is in the is fitting in the total available hours, that is 10,000 hours. So this 3,000 bottle will require 3 lakh bottle will require, it produces 40 bottle per hour, it requires 7,500 hour. The company has capacity of 10,000. If we deduct 10,000 10,000 minus 7,500, we will get 2,500 additional hours, that is unutilized hour. And if the company if the company wants to manufacture, if the company manufacture that 40,000, how much are that 40,000 toy, how much are that will require is 16 hours per toy. So in all it will require 2,500. So there isn't any opportunity cost or loss to the company. Means 7,500 hours can be used for the bottle and 2,500 hours can be used for the toy. So it can be run to its maximum capacity of 10,000 hours, and there would be any there will not be any contribution or contribution lost as such of any product. So do you advise the company to take up the order of the manufacturing plastic mold toy? Yes, generally answer will be yes, but how to start is, first we have to prepare the what we can say contribution per unit of toy as well as bottle. So we have to prepare a tabular form data. What we will do first is write the sales minus variable cost, and we will find out the contribution per unit. So sales is, see we can directly go to the solution part. Demand is 3 lakh and 40,000, sales is 0.8, and over there it was selling price is 30, variable cost is 0.32, and 40 24 is the variable cost. Then specific fixed cost, it has said in the question that it will be near it will be incurring 1 lakh rupees fixed cost, divided by 40,000, it is 2.5. so we will deduct that 2.5 special fixed cost. We will get a contribution at 0.45 0.48 and 3.5, and the machine hours required per unit is, how much machine hours is required per unit. Simply what we'll do is, over there it was requiring 60 60 bottle are produced 60 are produced in, sorry, bottles, how the bottles are manufactured, 40 bottles are manufactured in per hour. So if we divide it by 60, no, wait a second. So the first question answer will be, B and Z can accept the plastic mold toy order as a sufficient number of hours, that is 2,500 hours, 10,000 minus 3 lakh into 0.25 hours are available to be able to generate the additional benefit of 3.5 per unit on 40,000 toy, that is 1,40,000. so it is gaining 1,40,000. how this 40,000 1,40,000 came is, we would be gaining, that is toy na? So 56 into 40,000, sorry, 56 per machine hour. Contribution is 3.5, basically 3.5 into 40,000, it amounts to 1,40,000. so 3.5 into 40,000, we will get a profit of additional benefit of 1,40,000. okay, now in second question what they have asked is, if the order for the supply of the bottle has increased to 4 lakh, will you advise the company to accept the supply of plastic mold toy? State your answer. So if the supply is of 4 lakh bottles, so what we will first check is hours available. 4 lakh divided by 40, so it is 10,000. so we are not left with any capacity so that we can produce the toy. But now we have to see that whether producing toy is beneficial or bottle. So it can be clearly we can clearly see that producing toy is beneficial because it is giving 56 rupees per unit per hour machine hour contribution, compared to 19.2, which is which the bottle is yielding. So we will actually sacrifice the sale of the bottle of 2500 R, and we will manufacture the toy. So they have presented the answer for that only. So in order to supply the bottle, if the order of the supply of the bottle increases to 40,000 4 lakh bottle, then 2500 more will be required to produce the additional bottle. BNZ has decided whether to utilize 2500 hours for the existing bottle or for the toy order. The machine time is the limiting factor, therefore the contribution per machine hours from the both activities should be calculated to decide whether the cost should be accepted. The contribution per hour is more in case of the toy, it is 56, and then bottle, because it is 19.2. Therefore the BNZ should utilize the remaining 2500 hours for the manufacturing of the toy rather than to fulfill the order of the supply of the additional bottle, prioritizing the production based on the contribution per machine hours would maximize the profit. However, existing order fulfillment is necessary for building the long term relationships. So see, if we will see from the financial point of view, then manufacturing of bottle is toy is beneficial than bottle. But if we see from long term perspective, the if we are losing the sale of the bottle, we are losing our customer. Basically we would be losing our customer if we don't fulfill their order, and this will also affect the customer relationship. So however, the existing order fulfillment is necessary for building the long term and sustainable customer relationship. Developing and maintaining the long term and intimate relationship with the profitable customer provides the value benefit to the company. As the relationship between the company and the customer grew, a number of the customer who are satisfied with the customer product and the services tends to commit the relationship and buy more over the time. So the existing customer will buy more over the period of the time, that will be benefited, that the company will get the benefit. Cost of keeping the existing customer is less expensive than the cost of acquiring the new customer. So we can see that the cost of keeping the new customer will always be less than the cost of the acquiring new customer. Hence the BNZ should take into consideration the long term supplier relationship before accepting the toy order. So it should consider this factor before accepting the toy order based on the financial consideration, as the consideration per hour is more in the case of the toy. Further, the company should also explore outsourcing opportunity for production of the toy. So if it don't want to lose the customer, they can either also have an option of outsourcing the production of the toy. So they should look into all these considerations and then decide on whether to accept or to outsource, or what decision to make. And the third part they have asked is, an associate company BNZ has an idle capacity. The associate company of BNZ has the idle capacity and is willing to take up the whole or the part is willing to take up the whole or the part of the manufacturing of the plastic mold toy on the subcontracting basis. So there is one associate of BNZ which has an idle capacity and can take the production and manufacturing of any plastic mold toy on subcontracting basis. The subcontracting price inclusive of the cost of the construction of the mold toy is 28 per toy. Determine the minimum expected excess machine hours capacity needed to justify the producing any portion of the toy order by the company itself rather than subcontracting. So the subcontracting cost is 28 per toy. So we have to find out the minimum expected excess machine hour capacity needed. So we need to find out the hours basically. Okay, so what we will do is, minimum number of the toy needed to manufacture justify the increase in the fixed cost of 1 lakh to make the mold toy of 25,000. To make the mold is 25,000 toy. Thus, as long as the company has the excess capacity available to manufacture more than 25,000 toy, it is cheaper to produce than to buy from subcontractor. Minimum expected excess capacity will be 25,000 divided by 16 toy. How this 25,000 first of all we got is, we had to see the fixed cost, that is 1 lakh, divided by change in variable cost, that is we were incurring 24 and the outsourcing cost is 28, so divided by 4. So there will be we will get 25,000 toys, and we will once and for getting the excess capacity, the minimum expected excess capacity hours to justify is 25,000 divided by 16, so it is amounting to 1562.5 hours. So above this hours, so if we are left with the excess capacity above this hour, so it is beneficial for manufacturing, and if we have excess capacity less than this much hours, that is less than 15,624, then it is beneficial for what we can say outsourcing. See, it is given in the question also, the above pair also. See, thus as long as the company has the excess capacity available to manufacture more than 25,000, so until and unless if the company has the capacity to manufacture more than 25,000, it is cheaper to produce, that is to manufacture in house, than to subcontract. So we can conclude that if the hours available is above 1563 or 62.5 hours, so it is beneficial to manufacture to that extent, and if it is not available, so if it is available less than, so for example only 1000 hours is available and 9000 hours are been occupied by some other production of the bottle, so it is beneficial to what we can say outsource rather than manufacturing. So with this we are done with the illustrations part, and you can go through this last illustration, and from next next video we will continue with the test your knowledge part. Okay, thank you for watching the video.